What's up, Facebook Live? It is Tuesday at 11 a.m. That is when we go live, HMB Live. Tuesday, 11 a.m. Make sure you're here every week. This is the only platform in the private real estate lending space where we can talk business, we can talk finance, we can talk real estate. I'm Jason Balin. Sitting next to me, or sitting on the camera next to me, is Chris Haddon, both from Hard Money Bankers. And we are here to help. We're here to help. We're here to talk. We're here to chat. We usually do have a topic in mind every week. Today we're going to talk about knowing your numbers as a real estate investor or as a flipper. If you're flipping properties, knowing your numbers. And we're going to go through. That in a second. We have some good stuff to discuss related to that. But as always, please comment below and in the little comment section. And let's chat. Anything that you need, we're here. Also, I am going to put a link in here right now. And if you want to come on the show and ask any particular topic, you are free to do. Cool. How's that sound, Chris?
That sounds great to me. Yeah, everyone, as we're going through some of these things related to knowing your numbers and how incredibly important that is, feel free to comment, ask questions. We'll jump in. And hopefully we can provide a lot of value, because I think that the real estate investment community lacks certain things, and that is part of what we're going to be talking about today. I mean, the fact of the matter is that anybody can go out and buy an investment property, right? As long as you can get the money together, you can go buy one. You don't have to have a license. You don't have to pass any tests. You don't have to be certified from any kind of board. You can just go buy a property and try and sell it for more, right? So yeah, that's a good thing in certain ways. But it also puts new investors, especially, in a position of making mistakes and not truly knowing what they're doing. And that could apply to different things in construction and everything else. But today we're just talking about the actual financial breakdown of your deal. And it's a little scary because too many investors that we see, and even people that we know, frankly, don't know their numbers, and they're fudging them, and they're guesstimating, and they have an idea. And you know exactly what happens when somebody does the numbers in their head. How's that work out?
It works out exactly like that. And guess what? You're, oh, hey, I made this amount. No, you didn't. I promise you, you made a lot less than you think. You're always very optimistic when we do things in our head.
Exactly. Exactly what I was going to say is that people's brains and their optimism and how they want the deal to work out is going to tell them that they made X. And when you put the numbers on paper, it is always, always, always different. Almost always less. So real investors doing their thing, they have a spreadsheet they work through. And a lot of people who are just kind of winging it, they don't. And we have some free tools for that and everything else, because we want to encourage people to be professional and to do their numbers the right way. But the fact of the matter is, a lot of people won't do that. But if we can influence a few people checking it out today to really walk through a proper tool or spreadsheet, what have you, to get to their bottom line, and do it before and after, right? Like, do your numbers when you're going to acquire a property, and then what actually happened, and look at them side by side. You can really, really improve your game by doing that. And so few investors do. The top ones do, I can tell you that much, but the majority of them don't.
And there's also a lot of additional costs that other people don't realize that are involved in real estate investing. You know, most people say, well, as long as I get my construction costs on point and I reach my budget, I should be fine. But there's also a lot of other costs that we're going to talk about that just have to be taken in consideration. You know, numbers don't lie, right? Your numbers are right or your numbers are wrong. It's very, very simple. And on the front end, if your numbers don't show that you're going to make a big profit, well, guess what? You're not going to make a big profit. It works exactly like that. So make sure in the front end your numbers work fine, and you execute, and it'll work out. So let's dive into this a little bit. As always, comment below anytime you have any questions, and we will jump on and happy to answer them. We're usually on this broadcast as long as we need to make sure all the questions are asked and answered. And also, I'm going to throw a link up here right now. And if you want to click on that, you can actually jump into our green room, into our lobby, and you can ask a question there. You can actually be on this live broadcast with us. So if you're interested in showing up live, click on the link. If you just want your question answered, comment below. So the first thing, obviously, we break down knowing your numbers. It's actually pretty simple, but you do have to make sure you fully understand it. So obviously the purchase price is, the one thing that you got to take a look at. Purchase price is obviously pretty simple. What are you acquiring the property for? So you want to add that into the mix. The next thing is your construction costs. So you start with your purchase price, you start with your construction costs. Hopefully these numbers combined equal 65, 70 cents on the dollar. If it equals more than that combined, punt, because it's already a bad deal without anything else involved. In a future show, we'll talk about properly evaluating properties so you understand the right numbers to resell these things at, but let's just assume that you know that number. So you take that after repair value, the resale number, you times it by 65 or 70%, between 65 and 70%, and that number should be your purchase price and construction numbers in line. When you're doing construction bids, make sure you're getting them from multiple contractors. You have contingencies in there and things like that. So assuming those two numbers are in line, your first set of costs that you really, really need to track are your closing costs. Now, your closing costs inside of transaction, we're not talking about anything related to money or finance at this point for the deal. We're talking about closing costs, right? Title fees, title insurance, transfer recordation taxes, maybe property taxes, maybe property insurance. This is going to run between 3% and 5%, right? So if you're buying a property for $100,000, it's going to probably cost you close to $5,000 just to purchase the property. If you're buying it in finance, the closing costs are the same if you're using financing or if you're using cash, right? These are hard costs. These are not make-believe. These are not guesstimates. Like these occur, and you need to you need to take them serious, and you need to take them into consideration. A lot of times when you watch flipping shows and things like that, none of these things are in play. It's, I bought a property for 100, I put 30 into it, I sold it for 150, and I made 20 grand. That's baloney, and you know that, right? Like, if those are the numbers, I promise you lost money on that investment. Not even broke even. You lost money on that investment. And as we go through some of these other costs, you're going to see why. So if you're just chiming in, we are here, HMB Live, Facebook Live, every Tuesday at 11 a.m. We talk real estate, we talk business, and we talk finance. Any questions, comment below. And if you want to jump on the show with us, feel free to click this link that I'm about to put up there. All right, so let's talk financing costs a little bit, because financing costs could differ. They could differ based on if you're getting bank money, if you're getting a hard money lender, if you're getting private money, if you're doing a joint venture with somebody. Most people out there that are flipping houses do have finance costs, and they do need money for their real estate deals. So it's important to kind of understand. If you watch our show that we did last week at 11 a.m. on Tuesdays, kind of a trend here, Tuesdays at 11 a.m. If you watched our show last week, you'll see that we did a whole show about different ways to get money for your deals. So you can circle back on Facebook Live and touch base there. But typically your finance costs are going to end up being, 5, 6, 7, 8, 9, 10% for the life of the deal. If you're using a hard money lender, it's going to cost 3 or 4 points, maybe 13 or 14% interest. If you're using a bank, maybe 5 or 6% interest with a point. A private lender, maybe a point a month to carry it. It should cost about 10% for the money. Even if you're using a really expensive hard money lender, it still should only cost 10% for the money. And let me explain a little bit, because this could confuse people. So let's say you use a hard money lender and they charge you 15% and 5 points. Just so you know, we don't charge 15% and 5 points. We're much lower than that. But I'm just using this as in case you're getting a higher interest rate hard money loan. So a 15% rate means 15% annualized, right? That's over a year. If you need a year to flip a house, there's something wrong. You need to execute and move quick through these projects, right? So let's say you only hold the loan for 4 months, right? 4 or 5 months. You flip the property in that. I'm going to use my trusty calculator right here. And if I take, 15%, and I do that over like a 4-month period, it ends up being about 5% or so for the money, right? It's about 5% or so related to interest payments. And then you have points on the front end, which is another 5 points, right? So it ends up being 10%. So for every $100,000 you borrow, it's going to cost you 10 grand. Yeah, 10% for money. It's not that, it's not that big of a deal, right? But it just needs to make sure you're accounted for it.
Yeah. And in addition to, I'm just going to jump in for 1 sec on that, because you did mention an important thing that I'll touch on again really quick, is that when you're talking about financing costs, your timeline plays a big role in that. Like Jason said, like a lot of hard money lenders could cost you 20% annually, but in 6 months, it's only 10%. So if you're thinking about that 6 month to 12-month mark, say the job goes wrong, you have to fire contractors, you don't have your stuff together, you move too slowly throughout the whole deal in terms of resale and everything. Well, okay, there's going to be another 10% that's going to go into your financing costs during those second 6 months. Meanwhile, I'm sure your construction costs have gone up, and what you plan to sell the property for is going down in all likelihood. And that's when your profit goes from small to non-existent to a loss. So related to the time frame, make that as important as your numbers, which is what this talk today is all about, because your timeline directly ties into what those numbers are. So when you're going through, say, your construction breakdown, which is going to go over into your main spreadsheet for the deal, make sure during each phase of construction that you have dates. This is done by 5/15. This is done by 6/1. This is done by 6/15, and we list at 6/30. Make sure your whole team knows that. Every contractor, here's what we're doing. If you measure it, you can manage it. If you don't measure it, it doesn't get managed. It's just the way things work. So yeah, just wanted to jump in with that time frame thing there.
Yeah, I mean, we could do a whole show on properly executing, because that's that's the most important thing. But we got to start with the basics related to at least understand the numbers, because I'll tell you, I know a lot of real estate investors, and we do a lot of deals for, and even they don't know the numbers, and they think they know the numbers. They're like, hey, yeah, it's this, but their numbers are off, and they don't realize they thought they made 40. They're going to make 40 grand, and they made 25 grand. So
happens all the time.
Obviously, so the first part, jumping in like you just said, was make sure you're properly accounting for them on the front end, but then on the back end, you're properly tracking them and putting them into your QuickBooks or your Sage software or whatever, even if it's an Excel database, just something to make sure they're accurate and accounted for correctly. All right, so moving on from financing costs, any questions related to financing costs, please feel free to comment below and we'll jump in on that. Or if you want to be on the show, feel free to click on that and you can be on the show. Okay, so the next part is holding costs. I usually estimate about 2% for holding costs. And the reason I do is you have utilities that come in. The longer you have the property, the longer your utilities are. Your electric, your gas, your water, sewer, trash removal, things like that a lot of people don't account for. Maybe there's an HOA fee, maybe there's a condo fee, maybe you've got additional set of property taxes due if they didn't fully get paid for on the front end. Maybe you have some more insurance. So estimate 2%. That's what it ends up being, but it's an important one that a lot of people just don't realize. So make sure holding costs is a good one for you. Okay, so moving on, resale costs. Now, resale costs are funky, and a lot of investors are weird about it because they're like, oh, I'm just going to for sale by owner my house, or they forget that there's not transactional fees on the back end. So a few things on this. I like to estimate that our realtor fees are going to be about 5%, although we usually do our realtor fees about 4%. I would estimate 5%, unless you have a realtor you can work with, investor friendly, that's going to do it for you for 4%, which we typically do. I think that's important. And keep in mind, a lot of people will be like, hey, I'm going to be a real estate agent so I can save money on a deal. Well, you know what? You can save a little bit of money on a deal. But when you're an investor and you're selling a property, an investment property, keep in mind the majority of that commission is going to the buyer's agent. The buyer's agent who is bringing that buyer to you, not the listing agent. So most listing agents for investors are listing at a point, a point and a half, maybe 2%. A free thing that, hey, I'm just gonna be a real estate agent, I'm just gonna throw it on MLS and it's gonna sell. It doesn't work like that. There's time associated with that. So it's just something to think about. But the majority of that fee anyways is going to the person bringing the buyer. Unless you're doing the open house, you bring the buyer and things like that. But you should get that extra money. You're putting extra work in, and you're working hard to make that extra money. Transfer title fees, that's typically 1.5% as well. So right there, that's 6.5% between the two on the back end. And in the market that we're at right now, there's a lot of seller subsidy given. You got to remember that. 2%, 3%. The model of flipping houses works great in the median home prices, and also for first-time home buyers. A lot of first-time home buyers need seller credits, seller subsidy. So it's just something to think about. And it's pretty interesting. Like, if I told you that I could buy a property for $100,000 and put $30,000 into it and then sell it for $200,000, that's pretty much the example that we're talking about right now as we've been talking through this show. Someone says, oh, well, there's $70,000 of profit. You're not making $70,000, and actually you're not making $50,000. And if you execute perfectly, you may not even make $40,000 on this, right? You're going to make somewhere, when it's all said and done, about 35-ish, close to $40,000 if you execute perfectly. You flip the house in a few months. You don't go over construction, because keep in mind, you go over construction budget, you go over your time frame, your finance costs end up going up as well. So when it's all said and done, everything kind of implodes. So this is not to scare anybody. This is just reality. And let's be honest, if you're vested into $130,000 on a deal, if it's your own money or someone else's money, you should want to make $30,000+ on a flip. That's what it should be. You're not in this deal to just not make money. You're not just in this business in order to, as a hobby. Who wants to put up, hundreds of thousands of dollars, work their ass off for 6 months and make $5 or $6,000, $10,000? It doesn't work like that. So obviously make sure you know your numbers. I think that's probably the most important thing to start with.
Yeah, I would like to see, if I can just throw out to the group, if anyone can show an example of how they broke down a deal, exactly what they use, whether it's a spreadsheet or just a screenshot or, whatever it may be, showing what it looks like when you went through every single number in a deal, and that you have that handy and that you know your numbers. Of course, we know good investors that we lend to, that we partner with, and everything else, people who've been doing it for a long time that could answer that question in 2 seconds. But my guess is that a lot of newer people, they don't have those numbers handy. They're in the middle of a deal or they've done one, but they don't have it together. And that's, something that we're trying to help people out with. So if anyone does have an example of how they do it, that'd be awesome to share with the group.
Yeah, I agree. Think about it. Think when somebody comes to us for loans, JVs, and things like that, or if you're looking to just raise capital on your own from private investors, you need to fully understand what's going on inside the transaction. If you don't know, then there's no point of doing it. And this isn't hard, right? There's nothing hard about real estate. There just isn't. It's tricky and it's challenging, and you got to be smart and you got to execute properly in order to succeed. But it's not brain surgery, right? You don't need a high level degree. You don't need any of that stuff. So it's all possible. It's all able to do. So we got a question here from Doug Wilson related to, do you require a personal guarantee? And the answer is yes, we do require a personal guarantee on most of our loans, but I'll put a but in there. At the right LTV, we would consider not having a personal guarantee. For instance, you're not going to get 65 LTV. to directed IRAs that buy properties. Investors buy properties in their self-directed IRA, and a self-directed IRA cannot guarantee a loan. So we do a non-personal guarantee loan, non-recourse loan on that particular property. Again, we're not doing 65 LTV. Maybe we do 50 LTV, maybe somewhere around that. Maybe you bring a little bit more money to the table than normal, but I'm happy to give you a quote with a personal guarantee and without a personal guarantee, and you determine as an investor which one works best for you. Hopefully that answered your question, Doug. I appreciate the comment. So, yeah, I mean, I going back to that personal guarantee thing, I think that is a good question, and we should actually do a call related to, or a show in the near future related to self-directed IRAs, because I think that's one missing link. That there is a lot of education out there for it, but sometimes it's the wrong education. And we know a lot about self-directed IRAs, and we know a lot of different ways that you can invest with them the right way, that you're in compliance with the custodian to make sure you're doing it the right way. And there's a lot of things you can do with an IRA. And the cool part about an IRA is a lot of people might not have tons and tons of liquid cash, but they do have money stocked away in some sort of self-directed vehicle that they have access to buy a property with. So, and again, so that personal guarantee question, it is a good question. And I know there's a lot of lenders that say, no, we can't do that. But hey, let's be honest, I'd rather a lower LTV with more collateral than a personal guarantee anyways.
Yeah, I'd agree with that.
So obviously a big part of what we talked about today was knowing your numbers, tracking your numbers. We probably didn't talk enough about execution, even though execution is so darn important.
We can do a show about that. Yeah, we can do a whole live talk about that.
I mean, it's just so important. But knowing, tracking, just so everybody knows out there, we originally tracked a lot of our stuff on QuickBooks when we buy flips. We've been recently doing some of our flips, our active projects on a software called Sage. What is it? Sage Construction 100. Is that what it is, Chris?
Yeah, that's right.
We had a lot more options. We had a lot more real-time stuff that we were able to do. It was a lot easier to track. So in real time, we could run reports, see where we were in every project. We could set up budgets. We could edit budgets. That's what it's meant for. It's meant for that a little bit more than QuickBooks is. QuickBooks, if that's your option and your only option, and you can, separate a property by class, and you're able to, analyze it and do what you need out of it in real time, stick to QuickBooks. But I would recommend not just using an Excel spreadsheet. That's going to be a logistical nightmare in the future.
Yeah, I agree with that, especially if you're looking to do more than, 1 or 2 or 3 deals in a year. But if you are even earlier in your investing career than that, and the idea of accounting software just freaks you out, that's okay. Use a spreadsheet because it's better than nothing. Some people will cut checks without even tracking what's going on there, maybe handwriting checks or whatever it may be. So if you aren't ready for accounting software quite yet and doing tax prep with your CPA related to investment properties, just use a spreadsheet and know every dollar. Please.
Yeah. No, absolutely. Absolutely. That's important. Oh man, I think I had the wrong link to jump onto the show. I think I was doing show host and it had to be show guest. No big deal.
We're still figuring all this out.
That's the new one that I posted. Oh yeah, I guess I got to show that to everybody as well. I guess there's a difference. And also these comments are so delayed because the one that just came in was from like 11 minutes ago. But hey, it is what it is. It is what it is. So just a FYI, everybody, we do this show. It's 11 a.m. every Tuesday. Every Tuesday, 11 a.m. We'll make sure to put some links to it on Facebook ahead of time so you're aware. But just jump on your Facebook feed. We do it on the Hard Money Bankers channel. Just check your Facebook feed every Tuesday at 11 a.m. You can always comment below. Typical topics we're going to talk about are real estate investing, finance, and business. Just because, to be honest, that's just what we like. And that's just what we know, and it's what we talk about every day.
Yep.
It certainly doesn't. It certainly just doesn't need to be real estate investing. Real estate investing is just one kind of investment vehicle in this finance game that we all play on a regular basis. So we spend a lot of time on finance, and we spend a lot of time on business and marketing and things like that. So as you can probably tell, we do a lot of marketing projects, a lot of marketing campaigns. We're constantly doing marketing inside our operations. So if you want to talk about that, we are here as well. So cool. I guess we are going to wrap up unless we have any more last minute questions that come in. Looks like a lot of things kind of got held back because I don't know. There was a delay in this feed, but no problem. It is what it is.
It happens.
If you didn't catch us today, you can catch us at 11 a.m. on Tuesdays. And that's the HMB live show for you. Hope you enjoyed it. And if you have any questions, feel free to reach out to us, or you can just comment on any of these feeds, and we'll make sure to check them so we can broadcast live next week. See you guys next Tuesday, 11 a.m. Check you later.